To discuss Sweden, Japan, and gold, we're joined by Marc Faber, editor and publisher of the Gloom, Doom, and Boom report and director of Marc Faber Limited. Now, Marc, just today, Sweden took perhaps the most aggressive policy move we have ever seen from a major central bank. Not only did it announce a negative interest rate, but it simultaneously launched a quantitative easing program and gave guidance that it could do more, including buying bank loans unless it produced inflation. So what in the world is going on?
Some people say there is a currency war going on, but I don't buy that argument. In my view, central banks around the world are coordinating printing money one after the other. It's like handing over the baton to someone else. It started with the Fed, then went to the Bank of England, then the ECB, then the Bank of Japan. Every central bank will do the same. And in my view, if the dollar, as a result of these moves overseas, becomes even stronger, the Fed will then use a strong dollar as an excuse to ease again. This is what I think is going on.
Marc, you told Barron's just last month that if I could find a way to short central banks, that is what I would do. This is the year that people will lose confidence in central banks, mostly because of the failure of Abenomics in Japan. So how can one replicate a central bank short position?
Well, I mean, my sense is that eventually most investors will lose faith in money. You say, if you have to deposit money in a currency like the Swiss franc, and you get on 10 years bonds a negative rate of interest. In other words, for 10 years, you will lose money every year. And the money deposited is not that safe. I think a lot of people will rush and buy fixed assets, such as real estate. They'll buy gold and silver, platinum, palladium. They'll buy art. The latest art auction had a gold at over $300 million, and so forth and so on. I really feel that we are in a very bizarre and dangerous situation where the central banks are deliberately creating another colossal bubble in the world, a colossal bubble.
Now, Marc, gold has been treading water this year, and the last I saw it was just under 1,230 level per ounce. So what do you think of physical gold and paper gold, gold ETFs? What are your thoughts?
Well, I buy every month physical gold, and I own gold as part of my asset allocation. It's not that I have 100% of my money in gold, and I don't speculate in gold. These are my iron reserves. I'm not concerned about the price of gold. Maybe it goes down, maybe it goes up. If you buy Tesla, maybe it also goes down and maybe it goes up. Or if you buy Apple, maybe one day it's worthless and maybe one day it's worth much more. Who knows? The point is simply, I want to have some of my assets in gold. My concern, however, is this. The establishment, the central banks, the governments, and so forth, once faced with complete failure of their new Keynesian or neo-Keynesian economic interventions with fiscal measures, with monetary measures that have allowed global debts to still expand by $57 trillion since 2007. Once faced with these failing policies, they'll blame people who hoard gold, and they'll maybe expropriate gold. That is my concern.
And how about the gold miners? What are your thoughts there?
The gold miners are very inexpensive. So, say last year when gold rebounded by roughly 20% in the first half of the year, the gold mining indices like GDX and GDXJ went up by more than 40%. So if someone is more risk inclined, he will do better in gold miners. But there's a higher risk. It's more volatile. The gold price drops $200, the gold miners are going to get slammed. If the gold price goes up by $100, gold miners will go up by a higher percentage.
Here's the thing, though, Mark. You know, global gold demand is at a 4-year low, with demand from China off 38%. Now, that's just huge. So why is gold not responding to the signals central banks are emitting out?
Well, you know, if you print money, one of the problems is that not everything goes up equally. And the central banks, essentially notably the Fed, has been printing money and creating bubbles since 1998. So we had the tech bubble, the NASDAQ bubble. Now, please tell me how many tech stocks that peaked out in March 2000 before the NASDAQ dropped 70% have made new highs? Very few. Then we had the housing bubble. Well, some housing prices in some areas are at record highs, like in the Hamptons, in Newport Beach, Park Avenue, Fifth Avenue, Madison Avenue, the high end. But most home prices are still significantly below the highs, and so forth and so on. And we had a commodities boom in 2008 when in July, the oil price went to $147. Now it's down to slightly above $50. All I want to say is the money flows not equally into the economy, and gold has done very well, like silver, since 1999. But we had this very meaningful correction post-September 2011. But look, I'm not here to recommend anyone to buy gold. I'm buying gold for the reasons I just outlined. And I have also real estate, I have stocks and bonds and cash.
That was Marc Faber, editor and publisher of the Gloom, Doom, and Boom report and director of Marc Faber Limited.